Taxes are based on one principle, the principle of robbing the rich to pay the poor. That is exactly what you'll be told if you engage a tax expert or any academia in accounting finance who has a bias in taxation. The government or Caesar must enjoy a part, must take a part of any income that you generate within the country and sometimes outside the country when you look at the residence taxation. Taxes are compulsory. The government is empowered to get taxes from you through the Taxation Act Cap 470 and periodically through the physical policies. The government will keep on changing the tax rate, imposing new taxes here and there in order to achieve its revenue targets. If taxes are meant to rob the rich to pay the poor, does that law define who a rich person is? And the answer is a no. But if you look at the application of the law and the marking or the red line that divides those who are paying taxes from those who are not paying taxes, which I will presumably say the rich and the poor, a poor person with regard to taxation law will be any individual whose earnings are below the minimum tax wage, or what we generally call the minimum wage. Those individuals, they will pay tax, but the amount of relief that they get from the taxman covers the amount of tax that they have paid. So the net effect is that they will have paid zero tax. So anybody who is earning more than the minimum wage, they end up paying an amount of tax to the government. Then the most important question to look at now is, how rich are you now that you are paying taxes? Because rich guys don't pay taxes, and in any case they pay the least amount of taxes. But the poor pay or carry the highest burden in taxation. And for that reason, as an investor, as a person who is working, building himself towards riches, creating wealth, it's important you get conversant with the taxation. The reason why you should get versed with the tax laws and the fiscal policy, or if not, you engage an expert or a person who knows much about that or advise you on matters taxation, is that law, and through the Finance Acts, the government incentivizes or manipulates taxes to affect different sectors and different forms of investment, the revenues, because of different or to achieve specific objectives. By so doing then, the law allows you as an individual to research it and evaluate or identify loopholes or areas of that law that you can take advantage of to reduce your taxes or tax liability, or forgo paying the taxes altogether. Those loopholes that you identify within the tax laws or that are based within the tax laws, meaning that if the taxman investigate, you, at the end of the day, you get exonerated and you will have no liability. Such areas that you take advantage of or such methods are called what we will call tax avoidance. So tax avoidance is legal. It is permitted by the law. As an investor, as an individual, you should identify those areas that you can take advantage of within the law to decrease or reduce your tax liability. Who wants to pay or give away his money to to another person. If you just run away with taxes, or if you use illegal ways to reduce your tax liability, such cases or such methods, we call them tax evasion or tax evasive methods, and those ones are punishable by law in law because they are illegal. The government would also want to protect its income or its share of income from your incomes. Today's video, we are looking at different forms of taxes from different incomes. And at the end of the day, you'll realize poor people pay more taxes than the rich people. To be rich, or the classification, the identification of rich and poor on the basis of the minimum wage, doesn't make everybody earning above the minimum wage a rich person. You will also notice that payroll taxes are the most punitive forms of taxes. And therefore, the most important adventure as an individual should be freeing yourself from payroll income, or using your payroll income, identifying the various tax avoidance ways that you can harness to reduce your payroll tax liability, and utilize that income to build your wealth, to build your riches, to free yourself from that huge tax burden. That is one area in personal finance, and a very important area in attaining your financial freedom. We shall be looking at the different forms of taxes from different forms of incomes in 3 seconds break, so don't go away. Welcome back. To begin with, we look at employment income. This is the most available form of active income. Majority of taxed individuals lie in this category. These are the most sought people by financial advisors for all manner of advices on how they can acquire freedom from the burden of taxation and financial freedom by the decisions that they make about their salaries. The tax laws provide so many incentives, so many ways in which an employed person can vary their tax liability. But one must know the provided ways on which you can utilize that. Most investment opportunities that we pursue out here, they are provided for in law for employed persons, and they are loaded with incentives, either reliefs on assuming certain forms of investments, or a reduction of the amounts taxable through the payroll. Payroll taxes, on average, you get taxed at over 30%. Then, looking at the other indirect taxes, after the recovery of the payroll tax, which is mainly the pay as you earn, you have VAT on goods that you buy using the same salary, the remainder of the salary, and other forms of taxes. 2, we look at interest income. Generally, interest income is what you get paid for by other people who use your money. In any arrangement or investments where you lend individuals or other people money, what you get back as income or compensation for use of your money is interest income. Interest income generally is taxed at the rate of 15%. Interest income will be divided into 2. We have qualifying interest income and non-qualifying interest income. That classification of interest into 2 determines the accounting or reporting of that tax liability. It means, or in this case, qualifying interest income, which is interest that is paid to an individual by institutions that are registered and regulated under the Banking Act, Cooperative Societies Act. So the qualifying interest now becomes interest that accrues to any of your accounts with a bank, cooperative societies, and central bank is also a bank. All those are qualifying interest incomes, and it means that the interest or the 15% withholding tax that is recovered or deducted at source on that income is final tax. Final tax means that you will not be required to account for that tax recovered through your tax returns. When you are filing your tax return, basically in law what you are doing, you are accounting for your taxable incomes and the tax liability. So with all the taxes on qualifying interest income, which is final tax, will not be required for your accounting. It is accounted for by the paying institution. There are exemptions to withheld taxes or the rate applied on various components of various form of investments which have qualifying income. But before we look at that, non-qualifying interest income is any other form of interest paid by other institutions that are not registered and governed under Banking Act or the Cooperative Societies Act. So a good example is a corporate bond. If you purchase a commercial paper for a company, the interest income that you earn out of that agreement, a borrowing agreement, will be withheld at 15%, but that is not final tax, which means that you will have to declare in your returns, but the amount that was recovered or withheld, you will have to net it off from your total tax liability to determine the net balance to pay. The exemptions or the variations on qualifying interest income. These mainly will apply in banks and central bank investments or borrowings. Bonds, which are the instruments used by the government or treasury through central bank to borrow from the local or from the citizens, have varied rates of withheld interest, withholding tax on the coupons. And this depends either on the type of bond or duration of investment, maturity of that bond. Infrastructure bonds are issued tax-free. So it means that the coupons or interest that you are going to earn from infrastructure bond investments will attract no withholding tax. While fixed coupon bonds investments that have a maturity period of more than 10 years or 10 years and above will have a reduced withholding tax rate of 10%. That is very important. And treasury bills or any other bonds or bonds that are less than 10 years and treasury bills attract a withholding tax of 15%. But remember, it's final tax. It's final tax. And to be final tax, we've said that that interest income must be paid to you by institutions registered under the Companies Act, the Cooperative Societies Act, and the Central Bank, which is also a bank. On the other side, we have said that all other interests, it's 15% and not final tax. Then we have dividends. Dividend income is a share of profits or an appropriation of the profits of a company, which is paid to you as an investor and an owner of that company. When you purchase shares of a particular company, you are purchasing a portion of that company. So the share or the distribution of profits to the owners or as returns to the owners of the company or the shareholders is in the form of dividends. Dividends as well are divided into two or classified into two. We have qualifying dividends and non-qualifying dividends. Qualifying dividends or all dividends are taxed at 5% withholding tax. The qualifying dividend tax is final, while the non-qualifying dividend tax is not final. And the treatment for the accounting treatment for the same in your tax returns shall be the same as the interest income. The fourth one is rental income. Rental income will be divided into two. We have those investors who are generating rental income that is less than 5 million. And we have those who are generating rental income that is above 5 million. If your rental income is less than 5 million, you pay a tax of 7.5% of the gross rental income. 7.5% of the gross rental income. While if your rental income is more than 5 million, then that income is supposed to be combined or added to other incomes and taxed at the graduated scale rate. One can seek exemption from the Commissioner of Taxes for his rental income if it's below the 5 million to be treated the same as that one that is above 5 million. But it's difficult. Why would you want to engage yourself in such a amount of work in accounting for your rental income taxes? The main difference between the 7.5% and the over 5 million that is added to other incomes and tax at the graduated scale rate is that the person whose income is or rental income tax is at 7.5% gross, you are not allowed to deduct expenses that you may have incurred or you have incurred to generate that income. Majority of such people, they don't have caretakers, like they will have paid a caretaker salary. Many of them do not issue receipts. Although that one is getting, that's mischief is being cured by KRA. They are not issuing receipts. They are not incurring many expenses that can be claimable against or deductible against the income to get a net rental income to add to the other incomes for purposes or for tax purposes. Those are some of the basic taxes and how they are applied or treated to your incomes. But one thing that is very important that you should have noted is that as you accumulate your wealth, as you plan to run away from the payroll taxes, using your salary to purchase your financial freedom, as you progress in your wealth creation, your tax rates keep on decreasing as your incomes go up. So basically, the rich people, the wealthy people, pay little taxes compared to the poor people in the payrolls. Thank you for watching.